Good afternoon. My name is Allison Baker. I'm Chair of Venable's Financial Services Practice, and this afternoon we are going to be presenting the Evolving Paycheck Protection Program, how to interpret the forgiveness application and what to expect for next steps. And I'm joined by a really terrific panel of experts who have spent the last 6 weeks since the passage of the CARES Act studying in great detail the Paycheck Protection Program and all of its nuances. And today we're going to be discussing in particular the last step of the process, which is the forgiveness step. And I'm joined by my partner, Andrew Bigart, who is a partner in our financial services practice and focuses his practice a great deal on payments as well as anti-money laundering laws and has spent a lot of time looking at the PPP recently. I'm joined by my partner, Meredith Boylan, who is a financial services partner and a litigation partner and focuses her practice on managing and handling and responding to enforcement matters involving the government and financial services companies. I'm joined by my partner, Art Cyrilnik, who is a senior partner in our corporate practice here at Venable, based in San Francisco. I'm joined by my partner, Chuck Morton, who is chair of Venable's corporate practice. And I'm joined by my partner, Chris O'Brien, who is also a senior partner in our corporate practice based in Los Angeles. Today, we're going to be discussing the Paycheck Protection Program. We'll start, as always, with a little bit of an overview and reminder of the program itself and some of the parameters. We're going to talk briefly about the economic necessity requirement. Even though that has been discussed for the last few weeks, it still continues to concern and inform a lot of the decisions that borrowers take, deciding around whether to take the money or not, the Paycheck Protection Program, that is. We're going to be discussing the permissible use of funds, loan proceeds, and what expenses are eligible for forgiveness. We're going to be talking about the forgiveness application itself that the SBA has issued, and of course the interim final rule on forgiveness that the SBA issued last Friday evening on the eve of a 3-day weekend. And then finally, we're going to be talking a bit about how you can be preparing yourself in the event that the SBA does in fact audit your file after you have taken this money and sought forgiveness. And in particular, before we begin, I just want to, update. This is such a dynamic and fast-moving process that, for example, a couple of hours ago, as many of you on the phone undoubtedly know, the House of Representatives passed a bill that is essentially it's a version of the Paycheck Protection Program. And what it would do is it would revise some of the components of the current existing program. Some of those proposed revisions would include things such as the ratio of what percentage of loan proceeds have to be used for payroll when you're seeking forgiveness versus other expenses. And in addition, there would be some other components that potentially, assuming it goes through the Senate as well, would involve extending out the relevant time period for the loan, extending the time that recipients have to repay the loan, and letting companies get loan forgiveness and defer payroll taxes. And my colleagues, Meredith Boylan and Art Cyrilnik, are going to spend some more time discussing the House proposal and what just passed the House literally a few hours ago. So just quickly, a brief overview of the program again. The CARES Act, which was passed and came into law on March 27th, Title I of the CARES Act is the Paycheck Protection Program. It allows for, eligible businesses that, generally speaking, have fewer than 500 employees, subject to a couple of other exceptions, to obtain a loan that is equal to 2.5 times the average monthly payroll that they incurred either the 12 preceding months immediately before taking the loan or the 2019 calendar year. Those loan proceeds are eligible. It can be used for making payroll. They can be used for paying existing mortgage interest, rent, and utilities, provided that those obligations predate February 15th of this year. And in addition, loan proceeds can also be used to pay other existing debt obligations. But I note that loan proceeds that are eligible for forgiveness cannot be used for other debt obligations, but can be used to make payroll, rent, utilities, and mortgage interest. The current ratio that's contemplated, and my colleagues are going to discuss this in a lot more detail, is a 75-25 ratio, meaning that at least 75% of the proceeds eligible for forgiveness have to be spent on payroll during the first 8 weeks of the program when you have the loan starting from the day of disbursement of funds. Again, some of these parameters are, as we speak, in flux to the extent that the House is voting on or just voted on a bill that would change some of those parameters, and the Senate is going to be considering a similar provision or similar bill. Again, the criteria for qualifying, and if we could advance to slide 5, the borrower has to have fewer than 500 employees, subject to some exceptions, including what's called a NAICS code. If you have certain NAICS codes, you can have more than 500 employees in your business, or if you are in the hospitality industry, and you have, for example, a series of chains, a chain restaurant, you can have no more than 500 employees at any one of those locations. There are some other ways of measuring as well, an alternative size standard test, which talks about maximum tangible net worth of not being more than 15 million. And then, of course, then the average net income after fiscal income taxes would have to not be more than 5 million as well. So that's an alternative size standard test in the event that the 500 employee or fewer test does not apply, but this alternative test does apply. A borrower can be qualified to obtain these funds. My colleague, Andrew Biggart, is going to take us through some of the scrutiny around the questions about economic necessity and specifically frequently asked question numbers 31 and 46, and how they've informed decisions about whether to take the Paycheck Protection Program. And so I'm going to turn slides over to Andrew, slide 6.
Great. Thanks a lot, Allison. And this issue of the economic necessity of taking a loan is definitely an important one for its own benefit, but it also interconnects, I think, with some of the other topics we're going to touch on later, including loan forgiveness and audits. So it's definitely something important for us to focus on. When the Paycheck Protection Program was first passed by Congress, most of the initial questions that we got were really about what Allison just talked about, qualifying for the loan, such as meeting those size test requirements. I think less attention, or maybe I shouldn't say less attention, but I think that most borrowers felt pretty comfortable with the economic necessity at the time that they were applying for the loans. And if you look at the statute itself, what the CARES Act says, it does require that borrowers make certain certifications in connection with applying for a loan, principally that the uncertainty of current economic conditions makes necessary the loan request to support ongoing operations of the applicant, which is a pretty broad, standard, not the most exacting standard. In addition, the CARES Act doesn't include a specific means test or liquidity test for obtaining a loan, and in fact, it expressly waives a kind of a credit elsewhere test that the SBA typically has under its program. So, given how this was set up and the economic uncertainty that everyone was facing, I think most people felt pretty comfortable if they qualified for the loan, going ahead and applying for it. And then as soon as some of those applications went in, a number of media outlets started reporting on some larger companies, very well-known companies that got some of these loans, which then resulted in Secretary Mnuchin raising this concern about larger businesses that didn't need the money obtaining the loans. And this resulted in a number of FAQs being issued concerning this kind of economic necessity test, and there has been significant evolution over time, but it certainly has caused a lot of borrowers to have to question whether or not they should have taken the loan, or at least to really focus in and clarify in their own minds that yes, they had sufficient economic uncertainty in order to have applied for the loan and keep the loan. Essentially, it started with an FAQ that Treasury issued after Secretary Mnuchin had raised some of these concerns, really suggesting that larger companies that have access to other sources of liquidity really didn't meet the standard, and that they were skeptical that a public company, for example, with access to capital markets, et cetera, whether that was really the type of entity that should have been taking out these loans. A safe harbor was therefore established where a borrower that felt it didn't meet the standard could return the funds without having any issues. If that deadline was subsequently moved, et cetera. And additional FAQs came out as well, kind of extending that issue about liquidity and access to capital to private companies as well. At the same time that all these concerns were being raised about economic necessity, Treasury and SBA also issued FAQs stating that they would be doing audit and loan reviews of borrowers. And the guidance that was issued initially essentially said that any borrower that took out more than $2 million in a loan would be audited, or certainly should expect to be audited. And I think that's where you start to see the connection between some of the loan forgiveness and other topics we're going to touch on later, where if you're taking out these larger loans, there's a real possibility that you could be audited. And we don't know what those audits exactly will cover, but certainly, would they be looking at, what was your economic justification for taking the loan, this economic necessity, and then whether or not, if there were any issues there, whether you would qualify for loan forgiveness and how all of that would play out. So it's certainly something that was causing a lot of confusion and concerns, I think, by borrowers. There's been some clarifications recently that I think have helped kind of refine these issues. On May 13th, SBA and Treasury issued a new FAQ number 46, basically limiting this prior FAQ, providing that borrowers that took out loans of less than $2 million would be deemed to have made this economic certification in good faith. Borrowers that have loans of more than $2 million will still be subject to these audits that have been promised. Again, I think there's still a lot to be seen as to exactly what they're going to entail. And FAQ number 46 also clarified that if borrowers are found to have lacked adequate basis for their certification, they will be required to repay the loan and won't be eligible for loan forgiveness. But they won't be, referred for a government enforcement action. So I think that helped also a lot of companies that were very concerned with the issues they've taken out. Just very quickly, again, there's no set test for what economic necessity is. There's a lot of different factors that can consider. We kind of view it as a totality of the circumstances test, access to liquidity and capital, how the business has been doing in light of this economic uncertainty, all these different issues that we have here on these slides. And I think a lot of our clients, what we've seen them do is go ahead and document kind of a memo to file, setting forth what their financial and operational justifications were for taking that loan, just to capture kind of in real time, that uncertainty that they were facing in the event that they do have to deal with an audit down the line, that they have that documented and in good order. So with that, Allison, I think we're probably ready to move on to the next section.
And Art, I think, is going to walk us through permissible uses of the loan and how to ensure that your loan proceeds are eligible for forgiveness.
Thank you, Allison. Yes, I'm going to be discussing both the permissible use of your loan proceeds and the expenses eligible for forgiveness. Some of this has been relatively static. It hasn't changed much since the beginning, especially the permissible uses of funds, but there are a few minor changes there. And then there's a fair amount that's changed recently in forgiveness calculations. I'm assuming that if you're on this call, you've probably gotten your loan already if you're focusing on the forgiveness aspect. So I don't want to kind of harp too much on what everybody's known for some time, but I do want to really focus a little bit more today on some changes that were released this past Friday evening in a new interim final rule, which gives guidance on a bunch of the issues relating to forgiveness. But just in the first instance, how can you use your funds from the loan? It's for payroll costs, which is a fairly expansive definition of payroll costs. That has generally stayed the same, though I do want to note that in the interim final rule that was issued this past Friday, hazard pay and bonuses have been added as to things that are permissible payroll costs. Of course, those are still subject to the $100,000 cap per employee. Interest payments on mortgage obligations and other debt obligations incurred before February 15, 2020 are permissible uses, though just to reiterate what Allison noted a little bit earlier, while interest on non-mortgage debt obligations is a permissible use, those won't be eligible for forgiveness, just interest on mortgage obligations, and that's mortgages on either real or personal property. Rent is a permissible expense, and utility costs are as well. Things that you can't use the money for are for compensation of individuals at over $100,000 a year, and that's their actual salary, really. Benefits can count over and above $100,000, any amounts paid to employees with a principal place of residence outside the United States doesn't qualify, or you can't use the funds for that, or for leave wages already covered by the Families First Coronavirus Response Act. So on loan forgiveness, so how do we determine the loan forgiveness? Right now, under the rules as they exist right now, money spent on certain permissible expenses during the 8-week period after the loan is funded qualify in the first instance for forgiveness. Now, I will note here, this is one of the things that that Allison mentioned as well too. The 8-week period, which is the time you can spend your money for forgiveness, is considered as being in that bill that was passed by the House today, could be extended up from 8 weeks to 6 months, which will give you a lot more time to be spending your money in a way that qualifies for forgiveness. Now, this is all in a bill that just passed the House. The Senate has their own bill. We don't know how it's going to shake out, but it's very likely that one way or another this 8-week period is going to be extended, which is very important to you as to how to plan to use your funds. There's no longer necessarily the rush to spend the money quite as quickly if you're going to want forgiveness. It's a lot easier to spend in a way that may qualify for full forgiveness if you have a true 6-month period to spend it. It's the payroll cost as described in the prior slide that qualify for forgiveness, rent payments, utility payments, and interest on mortgage payments. And these are, generally speaking, either amounts paid or accrued during that 8-week period or whatever the extended period is. And there's a bunch of confusion really as to the issue of accrual versus payment. We've gotten a lot of questions on what if, on the first day of your loan period, you're making the payroll that covers the 15-day period prior to the loan. Is that something that's eligible? And then what happens on the back end of the loan? I think the SBA got a lot of questions about that too. And what they've provided is if you make your payroll biweekly or more frequently, there's going to be an alternative period for doing your payroll calculations to avoid payroll crossing periods that either predate or postdate this 8-week period. And what the alternative payroll period allows you to just start counting your payroll on the first day of your first new payroll period during the 8-week period. So assuming you get your loan on let's say May 13th, for example, and your first new payroll period starts on May 16th, you would run for the 8-week period from May 16th forward, even though that's technically otherwise outside of the 8-week period, the end of it. And that really makes it a lot easier to track your payroll rather than having to have some of your payroll be excluded because it's before or same issues kind of on the back end. So I think we're kind of recommending that for administrative convenience, that probably makes the most sense for people. For non-payroll, there's been a significant change in the interim final rule, which seems to allow additional expenses that we didn't think could be qualified for forgiveness before to qualify. And they say for non-payroll expenses that are otherwise eligible for forgiveness, you can count anything that was paid during the 8-week period or accrued within the 8-week period and is paid in the next normal billing cycle. So they give an example, and I think it's important. They say that if you borrowed on June 1st, such that your 8-week period would end July 26th. After June 1st, you get your May utility bill and you pay it. And then you get in July your June utility bill and pay it. That's 2 full bills that will count for forgiveness. But then they continue on to say, for the bill that covers the remaining period of your loan, or your 8-week period, in July, that will qualify as well. So in this example, they say that you get your July utility bill August 10th. They allow you in that instance to say that since your 8-week period ran out on July 26th, you can still deduct the amount of your utility payment attributable to the period July 1 through July 26th. So what that allows you is almost 3 full months of utility payments in that instance, which is more than we've anticipated before and is a meaningful change. They justify it saying it's de minimis because right now you can't still have more than 25% of the amount forgiven being paid on non-payroll items, so they think that will be a cap. The example they gave is in the context of utilities, but technically rent is also a non-payroll expense, and the same logic that applied to that example for utilities could apply to rent as well. So it may be, anywhere from actually 2 to 3 months worth of those non-payroll expenses that could be included in your forgiveness. So to go on, per the next bullet, as mentioned right now, just go back a slide, thank you. Not more than 25% of the amount that you're seeking forgiveness for can be for non-payroll expenses. So that's kind of a cap on that. But as was mentioned by Allison earlier, in the version of the bill passed by the House, it seems like that 75% may go down to 60%. So that up to 40% of the forgiveness can be for non-payroll expenses, but we're going to have to see how that shakes out. The next couple of items I think are really dealt with further in the next slide, and so I'll pick them up on slide 15. So if you start with the notion that everything that you spend on a permissible expense that's eligible for forgiveness is forgivable, arguably your entire loan proceeds could be subject to forgiveness, subject to the 75-25% cap I gave before. But now there are some clawbacks against that. What happens is if you don't have the same number of full-time equivalent employees in the 8-week period after the loan has been funded versus one of two periods, the FTEs from either February 15th, 2019 to June 30th, 2019, those are average monthly ones, or January 1, 2020 to February 29th, 2020, your forgiveness is subject to basically being cut back. So for example, if in this new 8-week period, you only have 80% of the FTEs that you had during one of those two prior periods, you pick the one, and you would always pick the one with the lower FTEs, so it's easier to hit. There'll be a ratable reduction. So if it's 80% you maintain, if you otherwise had $1 million that was eligible for forgiveness, it would only be $800,000 subject to all of the other parameters I gave you before. There is some new guidance on this issue. There was some question as to what was going to be an FTE. The thought had been it was maybe going to be someone working 30 hours a week, but they've determined to now make it 40 hours per week. This is done kind of, the FTEs are computed in the aggregate. I'm going to talk about something else dealing with salary that's on a person-by-person basis, but no employee can count for more than 40 hours per week. And so, if you have a person working 50 hours a week and one working 30 hours a week, and they would average out to 80, that is not 2 FTEs. The person working 50 is capped at 1 FTE. The 40 hours and the person working 30, let's just assume for our purposes, we count as 3/4 of an FTE, subject to the rules that I'm about to discuss even further. They've now indicated that for simplicity of counting, for counting your FTEs, anybody who's working less than 40 hours a week, you have a choice of either counting their actual hours versus 40. So if someone's working 30 hours a week and 40 would be 1 FTE, you take 3/4. So they would count as 0.75 FTE. Or alternatively, for everybody working less than full-time, you can count each of them as 1/2 of an FTE. And so you're going to have to do your calculations. If you have one person working 30 hours and one working 10, it's going to average out to 1/2. And it doesn't make a difference really which way you go. It's the same result. But if you have like one person working 30 and 8 people working 10 hours a week, you're much better off counting each of them as 1/2 an FTE. And you're going to need to have consistency in your FTE headcount for the 8-week period versus whatever the comparison period is you're using, which is, as I said, is either February 15th to June 30th, 2019, or January 1st to January 29th, 2020. In your FTE count, and this is all some new things that have been clarified, if someone quit during this 8-week period, you can count them as an FTE. If they were fired for cause, you can count them as an FTE, and if they ask for a schedule reduction, you can count them as an FTE. And for those who are there are a bunch of people who are paying people to stay home. They're going to count as an FTE based on the number of hours you're paying them for. So if they were a 40-hour a week employee before and you're paying them full pay, they're going to count as a full FTE. If they were making, if you're now paying them basically half of what you were otherwise paying them before, they're going to count as kind of a half an FTE. And this is all kind of new guidance. Okay, so moving on. Bear with me. So now we're going to talk about, oh, I'm sorry. Let's go back to slide 15 for a moment, if you don't mind. Reductions in payroll is another way that your forgiveness can be reduced. For any employee making less than $100,000 a year, you can reduce their compensation by not more than 25%. To the extent that you reduce them by more than 25%, each dollar of reduction beyond the 25% is a reduction to your ultimate loans forgiveness. So a simple example, someone was making $100,000 a year, you reduce them to $70,000 a year. You could have reduced them to $75,000 without accounting, but to the extent you reduce it to $70,000, that extra $5,000 would count as reduction. Of course, those are annual amounts. We're just taking the monthly amount. So what would happen is you would take, that $5,000 and divide it by 2 over 12, 2 basically being 2 months versus the 12 months that the salary is paid over. And so that's what's right. Interestingly, they did make they issued some guidance here as well, that if someone's salary is reduced, in part because their hours are reduced, that part of the salary reduction attributable to the reduction in hours will not count. So in a very simple example, someone was working full-time and making $100,000 a year. You've now reduced their hours to 20 hours and a week, and you've now reduced them to $40,000. The first $50,000 of the reduction, that's from going from $100,000 a year to $50,000 a year, is deemed attributable to their reduction in hours and is not going to count as a reduction in their pay. The amount beyond that is what would count as a reduction. So in this instance, they'd be deemed to go from $50,000 to $40,000. That's a $10,000 reduction out of 50, which is only 20%, which is less than the 25% threshold. So you're not going to be charged in any way back against your forgiveness for that reduction there. The theory on the government is they're already charging you because you're taking a full 1 FTE and turning them into half an FTE. So you're being penalized already. They're not going to penalize you again for the reduction in their salary attributable to the reduction in the number of hours. Okay, go to slide 16 now. So what happens is now, after we've discussed these reductions to forgiveness, there are ways to earn them back. And the ways to earn them back are, at least under the current rules right now, if by June 30th, any person that you fired between February 15th of this year and April 26th of this year, if you hire them back by June 30th, they will go into your FTE headcount. Similarly, if you reduce their salary by more than 25% compared to what they were making as of the prior quarter, and you reinstate their salary to what it was as of February 15th, you're not going to be charged for the reduction in their salary as well. Finally, for purposes of your headcount in determining FTEs and based on rehiring, if in fact you offer to rehire people at their full prior wage and for the same number of hours, and they refuse to come back, you can treat it as if they've been rehired, and so they can go back into the headcount. But the one condition is that you need to notify the state unemployment agency where they're working that you've made them an offer of rehiring and they have declined that offer, which may lead to a termination of their unemployment benefits for refusing to accept employment back. That's it for my section.
Thank you, Art. We're going to talk a bit about the loan forgiveness application as well that was released about 10 days ago or so, maybe a little longer than that, I guess May 15th, by the SBA. And Meredith, if you can also make sure that our audience has the CLE code for today's program before you begin, that would be fantastic. Thank you.
Sure, thank you. Yes, we're offering CLE credit for today's webinar. The code that you'll be asked to enter is forgiveness. As Allison mentioned, the SBA released an application, and I'm saying an application, for the forgiveness program about 10 days ago. Given the ever-changing landscape here with the congressional developments, I think those of us on this call expect that if some form of the bill that was passed today ultimately is enacted into law, we will be seeing a new version of this application because the legislation contemplates some changes that are directly relevant to the calculations that are built into this form application that the SBA has provided to borrowers. As we mentioned earlier in the call, there's a proposal in the bill, the current bill, that the 75-25% ratio would be a 60-40. There are some extensions to the safe harbor period. There are extensions to the period for in which you need to spend the funding from 8 weeks to 24 weeks, and there are some additional relaxation of the rehiring and FTE ratio counts that may impact some of the formulas that are currently articulated in this application. With that caveat, we'll march through the application as it stands, and I won't get too bogged down in the minutia of the calculations if they do change, but just to highlight some of the facets of this application that are likely to stick, whether it's this version or a new version or two versions down the road. So first of all, a basic concept here is, just as with the application for the PPP program itself, the forgiveness application will be completed by the borrower and will be submitted to the lender. It is not submitted to the SBA. The application itself is an 11-page document that is chock full of different instructions and worksheets. The information that is submitted to the lender may ultimately be the 2 pages that are required under the instructions of the application itself, which is the forgiveness calculation form, which is a one-sheet form, and a Schedule A, which sort of shows the math behind the calculations that will ultimately be appearing on your Schedule A. There are some noteworthy aspects that were apparent in the application that were not apparent before the application was released. As Art noted earlier, probably one of the more notable developments is the concept of an alternative payroll period, which should help some borrowers, maybe many borrowers, streamline the application process, because it allows you to essentially conform your calculations to your payroll cycles, rather than being wed to an awkward 8 weeks that may or may not align with how you actually pay your employees. One other noteworthy, and this is just kind of a record-keeping function on the base of the application, but I think for those of us who have been following the SBA audit and review and certification controversies, there is a representation that the borrower needs to make, which is checking a box on the front of the form that confirms that the borrower, together with its affiliates, and this is subject to the exceptions to the affiliation rules that would otherwise exist under the statutes, you have to indicate whether you've received loans in excess of $2 million. So, this aligns with the various statements that have been made over the last several weeks on the focus for review of the larger loans, and not only larger individual loans, but larger loans in the aggregate, unless, of course, the affiliation rule does not apply to your business. Another noteworthy, and again, this is, for those of us who have been studying this process, it's interesting that some of these developments come out through application instructions, followed perhaps by clarifying rules. But the the application itself clarifies that a mortgage is not just limited to mortgage on real property, but it's mortgage on real or personal property. So that's something that may help those of you who are trying to find ways to use your PPP funds. You may want to look at that both in the application. I believe there may be a reference to that in the most recent interim final rule as well. As Art mentioned, there is some additional flexibility in how you record your payroll costs, and it allows you to typically the paychecks would be considered paid on the days that paychecks are distributed, and they are considered incurred on the day that the employee's pay is earned. But payroll costs that are incurred during the 8 weeks but not paid during the last pay period of the covered period or the alternative covered period are eligible for forgiveness if paid on or before the next regular payroll date. So that gives a little bit of flexibility there to report your payroll expenses for purposes of forgiveness. Similarly, with the non-payroll costs, you have the opportunity to seek forgiveness for costs that were incurred during your 8-week period and then paid on the next regular billing cycle. And I think Chris can offer a little bit more clarity on what that may mean from a numbers perspective when he follows me. There is a certification sheet that accompanies the application, very similar to the certification sheet that accompanied the original PPP application. And it again, the way that this program is designed and the way that the application for the program in the first instance was designed is that it really puts the burden on the borrower to validate and explain and certify to all of the information that is being used in these forms and that is supporting the documents that are being submitted to the lender. So you'll see that there is a list of, I think it's 7 certifications that require the borrower to confirm that the proceeds were used to pay costs that were eligible for forgiveness. And those are your payroll costs, your mortgage interest, your business rent or lease payments, and your business utility payments. You also have to certify that you've applied all of your applicable reductions. And that goes to the reductions that Art was speaking of earlier, your head count, your employee head count reductions, and your salary reductions. And so you'll see as we move through this that there are going to be worksheets that will inform your representations here. And you have to confirm that you're not seeking forgiveness for non-payroll costs in excess of 25% of the amount requested. Again, there's a lot of heavy language in here about certifying that you understand that this is all true. Again, this is a government form, and so it's not surprising that they expect you to attest to the legitimacy of the application and the purposes for which the funds were used. And again, just hammering down that the borrower is the one that's responsible here. The borrower has accurately verified that the payments for payroll and non-payroll costs are accurate. And so again, you're going to have to make sure that you've ticked and tied your calculations in a way that you're comfortable to make these certifications. You also are essentially giving the SBA and the SBA Inspector General access to your records around the PPP loan that you've received for a fairly long period of time. And we'll talk a little bit about those documentation requirements in a bit. But essentially, there's a 6-year retention requirement, and the SBA can ask to see the documents that relate to your PPP loan and your forgiveness calculations during that period. And then this I thought was very interesting is that the application itself includes a kind of a grandfather clause that states that the borrower's eligibility will be for forgiveness will be evaluated in accordance with the PPP regulations and guidance issued by the SBA through the date of the application. And for those of you who've been living with this process for the last couple of months, you may understand the significance of that, because the rules do change so frequently that this is essentially locking in the rules on the date of your application. So that may or may not be helpful, but it was something that I think is noteworthy for people to be aware of. With respect to the FTE count, as Art explained, there's two new formulas or a clarity around the formula of how to calculate FTE, where you can do a division, or you can attribute a 0.1 or a 1.0 or a 0.5 to your full-time and part-time employees. I think depending on your employee structure and your forgiveness calculations and ratios, one of those formulas may be more advantageous to your business, or the other, it's probably in your interest to go ahead and run the numbers using both calculations and see how it shakes out for you, because there could be some pretty material differences in how those numbers look. The salary hour wage reduction portion of the application makes it clear that this is an employee by employee analysis, and the tables I thought were helpful guides. It's on page 9 of the application, because they break out by your pay range who is considered for this 25% salary reduction penalty and who isn't. So the employees who received more than $100,000 are going to be separately listed than those employees who received less than $100,000 in 2019. And so that will help to clarify whether or not you need to take a hit on your forgiveness calculation for certain employees, because I think there have been some questions along the line that if you had somebody who made $125,000 in 2019 and you reduced them below 25% in 2020, would they be affecting your forgiveness calculation? And it appears from this structure that the answer is no. You'll see that there's clarity. I think this has been made clear through various guidance over the last several weeks, but you are not to include any independent contractors in your analysis here. And that was laid out in one of the earlier interim final rules, that payments to independent contractors are not eligible for forgiveness. Again, as Art noted, there's baked into this instruction sheet, it instructs that you are allowed to exclude employees or not rehire employees who were fired for cause, who voluntarily resigned, or who voluntarily requested and received a reduction in their hours. The catch, of course, is that you need to have documentation that supports all of that should you be asked down the line. And turning to the documentation aspects, you are going to be expected to submit with your application to your lender the bank account statements or third-party payroll records that support your payroll calculations. So that document the compensation that were paid to your employees. They also expect you to submit tax forms that validate this. And then if you've been making contributions to health insurance or retirement plans, those payments also need to be documented in a way that shows that you actually really did make those payments during the covered period. In addition to the payroll and compensation records, there's also going to be documentation that you're going to need to submit to support your various headcount calculations. And that's the headcount calculation for your covered period, whether that ends up being the 8 weeks as currently drafted or the longer, maybe it'll be 24-week period, depending on how the legislation is resolved. And then you're also going to need to show documentation that supports your comparison period. So when you have to do your calculation where you look at your current employees and compare it to your employees from one of the earlier February 2019 to June 2019 or January 2020 to February 29, 2020 time periods, you need to also provide the payroll records for that comparator period as well. And then again, for your non-payroll costs, you're going to want to be able to show the existence of the obligation itself, the lease, the mortgage, the utility bills, and that you paid those expenses during the covered period. There's another batch of documents that you do not need to submit with your application, but what you need to keep in-house for this 6-year period. And that includes your documents that support any claims that you offered an employee his or her job and they turned you down, that they were terminated for cause, or that they voluntarily sought a reduction in their hours during this covered period. And of course, our recommendation would be any other documents that support your initial PPP application or your forgiveness application. You'll want to keep those all in a file together so you have them and they're easily accessible should your loan get flagged for a review. And again, the language in the application is that you must retain them, the documents, for 6 years from the date that the loan is forgiven or repaid in full, and permit authorized representatives of the SBA, including reps from the Office of the Inspector General, to access those files upon request. And I'm going to turn it over to Chris to add a little more color to the application based on the interim final rule that was released recently as well.
Thank you, Meredith. And Chris, if you can walk us through the ever-changing labyrinth here that is the interim rule. And I want to note that we see that there are a lot of questions from the audience, and we may not be able to answer all the questions that have been presented to us on this webinar today, but we'll endeavor to definitely follow up afterward. Chris, if you can walk us through the rule that came down Friday night, that would be great. Thank you.
Sure. Thank you, Allison. So these rules are both complex and changing, and that's a bad combination when you're trying to comply. We could probably do a whole webinar just on the questions that were received during this webinar. Maybe we will. And I'll note that a lot of the things on the slides here, the next 3 slides, have already been covered by Meredith and by Art. So I'm going to try not to be redundant. I'm also cognizant of the time that we have left. But these may be helpful for you to absorb things that have been said by others. So these interim final rules came out on Friday, very late in the day on a holiday weekend. The first thing to cover is general forgiveness terms. These interim final rules confirm that eligibility is based on the guidance available at the time of the application, which may be of note for people where some of the guidance has changed. For instance, guidance regarding foreign employees that seems to have changed over time. Secondly, the guidance reaffirms that if only a portion of the loan is forgiven or forgiveness is denied entirely, the remaining balance is paid over the 2-year maturity date of the loan. In terms of payroll costs and guidance on payroll costs, the guidance restates that payroll costs have to make up 75% of the amount for which a borrower seeks loan forgiveness. Now, we've made several references to the 75% rule, and it's been a moving target and depends upon the source that you look at. So the original CARES Act was silent on the question of the proportion that had to be used for payroll costs. But Secretary Mnuchin seemed to come out and say that 75% of these loans would have to be used for payroll cost. The first IFR seemed to say that indeed 75% of the loan would have to be used for payroll cost. This IFR, the latest guidance, seems to say that it's 75% of the amount that is sought for forgiveness. And if you work through the application that was released at the same time, it's even more favorable to borrowers than that. It appears that if you work through, particularly on line 10 of the application, that the forgiveness is actually going to be based on the relationship between actual uses for payroll and 75%. So for example, as I do the calculation, if you used 50% for payroll, then you'd actually get 2/3 forgiveness because 50% is 2/3 of 75%. So there isn't a tremendous amount of clarity on those questions, and to make it even more complex, the House bill that was passed today seems to have a hard cap of 60% on payroll. Moving through the rest of the points, I'm not going to go through the second bullet point under payroll costs because Art covered it. This is the concept of an alternative payroll covered period for folks who have a payroll period that may start before the time they get the loan and end after they get the loan. There's some flexibility based or baked into this guidance. This guidance confirms that payroll costs are generally incurred on the day the employee pay is earned, and we have employees who are not performing work, sidelined employees, it's generally going to be on the employer's scheduled day when the work would have been performed. As Art mentioned, there is the addition of bonus and hazard pay, which we hadn't seen previously, and the guidance makes clear that wages to furloughed employees during the covered period would count. If we can go over to the next slide. For non-payroll costs, again, there's language that says eligible non-payroll costs cannot exceed 75% of the loan forgiveness amount. But as I just mentioned regarding the 75% being used for payroll costs, that has a direct relationship to the 25%. So if you work your way through the application, you wouldn't see that as a hard cap in terms of forgiveness. I'm not going to go through the second point. This was also covered by Art. This is the concept of non-payroll costs that might straddle or be pulled in from periods outside of the covered period. The third bullet point here, advance payments of interest are not eligible for, or on mortgage obligations are not eligible for forgiveness. In terms of forgiveness reductions, the guidance confirmed that EIDL advances will be deducted. I think that's just a confirmation of something we already knew. Art also mentioned the next point, which is headcount reductions that could reduce the forgiveness will not include voluntary resignations, schedule reductions, or for cause terminations. So that's an interesting point in terms of managing headcount during the period. The guidance also reaffirms issues about rehiring employees. If you make a valid offer to rehire an employee and they turn it down, then you're given credit for that employee essentially. But as Art mentioned, there's additional guidance here that says there's a requirement to inform the local unemployment office that that offer of employment was turned down. And in a lot of jurisdictions, that's going to mean that the former employee won't be eligible for unemployment benefits. Can we go over to the next slide, please? So salary and wage reductions, the guidance confirmed that the 25% salary wage reduction only applies to employees who make under the 100,000, not employees over the 100,000. And it's performed on a per employee basis, not taking your entire employee base of sub 100,000 folks. There's no double penalty for situations where there's a reduction in salary or wage and an FTE reduction. And then lastly, the remedies for reduction in the headcount, reductions only from February 15th to April 26th, not reductions that were done after that, will be counted in. As we've said a couple of times, the changes that were passed today by the House, if they become new guidance or part of the statute ultimately, could dramatically change this by making the 8-week period a 6-month period. The bill included easier guidance on rehires, easier language regarding rehires, and it appears to have a hard cap of 60% on payroll costs, not the moving target of 75% that we've talked about. So my feeling is, unless you're at a point where you are pretty certain that you'll hit 100% forgiveness under the current rules, you don't have reductions for headcount reductions, you don't have reductions for cutting compensation of folks under 100,000. Unless you're really certain that you're going to hit 100% forgiveness, it may make sense to watch what's going on here with changes to the guidance and to the law overall, because it does appear that it's getting more favorable to business owners as time goes on. So with that, I'll turn it back.
Thank you. Chuck, if you can walk us through briefly, I guess, given the time we have left, some thoughts and considerations that borrowers should keep in mind as they move forward here and apply for forgiveness. Thank you.
Sure, happily. And I've sat quietly listening to the presentation, imagining that I am either someone who already has an existing loan, or I've been dragging my feet and I'm thinking about applying and thinking to myself, my goodness, what does a smart, rational person do in reaction to all of these things? And really, there are 3 things that I would encourage you to do. First, if you've not yet applied, I would encourage you just to sit tight just for a few more days. Let's see what happens with the legislation that's working its way through Capitol Hill. Things could get better, and you want to be certain that you have the full benefit of those changes. Secondly, assuming you have a loan, I would download and print the loan forgiveness application, and I would fill it out as promptly as possible. Not with the intention of submitting it immediately, but with the intention of trying to understand how all of these moving rules apply to me, so that as I think about how to react to the evolving landscape, I've got some clear understanding about what it is. And then thirdly, I would find some solace in the fact that clearly loans of more than $2 million are likely to be treated differently than loans of under $2 million. If I'm in the under $2 million bucket, I would find some comfort in that, but not complete absolution, because the most recent guidance makes it clear that the SBA can, in its discretion, reach out and review any loan. But if I have a loan of over $2 million, I would know that an audit is coming. I would be prepared with documentation, as was alluded to earlier, and I would be building that file now so that it's easy when the time comes to submit your forgiveness application to have that stuff in order and not to be caught flat-footed. And beyond that, I would urge you to send your Venable lawyer an email and to try to get the specific questions answered. We will do our best to try to supplement there are more than 400 people who participated this afternoon, and we are awash in questions, and many of them fall into natural buckets. So with that trilogy of simple, actionable advice, I'll pass it back to Allison so that we can try to be respectful of everyone's time.
Thank you so much, Chuck, for that really fantastic overview. And thank you to everyone who listened in today. This is obviously a very important topic on everyone's mind. It's dynamic, it's changing. Our team on this call, our presenters, Andrew Bigart, Meredith Boylan, Art Cyrilnik, Chris O'Brien, Chuck Morton, and myself, Allison Baker, are continuing to monitor this situation very closely, send out alerts, and we will probably be having yet another webinar as additional guidance comes down from the SBA about the Paycheck Protection Program. So thank you so much for joining us today. We appreciate your time, and please do reach out if you have additional questions that we didn't get a chance to answer on today's webinar. Thank you so much. Have a great afternoon.